Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is open up your brokerage platform, and you want to just pull up any underlying, as long as it's not futures underlying, just pull up anything, and you want to get a list of expirations up. So we're looking at GLD right now. Um, and we want to, the purpose of this is to lock in on an expiration date, first of all, because obviously we are dealing with options. So it makes sense to know where we are in the option cycle. So the expiration date we want to pick should be between 30 and 60 days out in time, and it should be a monthly expiration, not a weekly or a quarterly expiration. The only expiration date that actually fits that criteria right now is December 20th, which is 45 days out in time, which is actually perfect. However, with the elections, US elections coming up, right now might not be the best time to put on positions. However, there is a case to be made that the more everything is priced into the market, so you could argue that it doesn't matter that there's elections. It's just another day. Um, so with that in mind, December 20th, that's where we want to be, 45 days out in time. So we could take that information and come over to our watch list, and we simply just filter out any underlying that has earnings over the next 45 days. So we do not want earnings to disturb our trade over our contract period. It will increase volatility. It will mess up our deltas. All of these things will have a negative effect on our P&L. And we also want to filter out anything that has a low liquidity rating level. We only want to be trading nice and liquid underlyings. So now at this point, we simply go down the list, and we want to sell premiums or short options contracts on underlyings that have an increased uh, volatility level, and the way that we can identify that is by using IV rank. So we've got everything listed from high to low IVR. Generally speaking, anything with an IV rank of over 50 can be considered high. Anything below 50 can be considered low. However, there are some exceptions to that rule. By the general rule of thumb, um, as long as you follow that, you'll be fine. So we just go along the list and we just see what would fit well in our portfolio. Now, DAL would not fit well in our portfolio because we've already got UAL and BA positions open. However, for the purpose of this example, I'm going to assume that you don't have the exact identical portfolio as me. This is just a small account. It is a live account, but it is a small account. It's pretty much just for example purposes, just to show you guys, how to open positions and manage risk. And so we could just have a look at DAL, Delta Airlines, right? It's currently trading at just under $58. It's at 57.70 right now. It's got an IV rank of 97.4, and it's got an absolute IV level of 44.9%, which is really nice. We've got LQD, which is investment grade corporate bonds. In fact, let's have a look at LQD. We've not had a look at LQD before. It's currently trading at just over $108. A nice and high IV rank of 96.3, an IV level of 12.2. Let's just have a look at it on the chart. This is what LQD looks like. As we can see here, IV rank is super high right now. Let's just mark the high on the chart as well. So we've got the high and the low. As we can see here, this is a perfect time to sell some premium. So let's come over to our trade tab, and we've already selected our expiration date, which is December 20th. And now we simply just choose what contracts we want to sell and where we want to sell them. And this is called the options chain. So what I like to do is I like to start off by selling one call, one put, and I like to sell them anywhere between 15 and 20 deltas. So if you come on the call side, we've got the delta column here. We've got an 18 delta at the 112 strike, which looks perfect. And then we've got a 20 delta at the 105 strike as well. So we've essentially created a range for ourselves between 105 and 112. Now, because IV on LQD is so low, 11.8%, we aren't getting that much of a premium on this position. And our buying power requirement is quite a lot, 1.8k, just over 1.8k in buying power. And this highlights something that is specific to equities. So the way that margin is calculated, it doesn't really take into account volatility. It doesn't use span margin unless if you've got a portfolio margin or a PM account, basically. Um, or if you're in a normal margin Reg T account, futures, if you're trading futures will take into account volatility. That uses span margin. But if you just got a normal Reg T account and you're trading equities like this, then you might not want to actually put this position. You might want to do it if you're in a PM account. Which does take into account volatility. But we're still going to continue with this example just to highlight to you the differences, because it's important to know what a juicy premium looks like. And in order to know what a juicy premium looks like, you need to know what a juicy premium doesn't look like. And this is exactly what it doesn't look like. So we've got unlimited loss potential, which is standard for every naked position, but it's going to require just over 1.8k in buying power. We'll collect $85 up front. We've got a 67% probability of profit, and 89 and 90% chance of hitting 50% of max profit at some point over the next 45 days. Now, this is a poor return on capital, so I'm going to show you what you can do to increase that. So let's say if you were to just buy another contract a little bit further out on both sides, it's just $1 wide on both sides. What we've essentially done is limited our loss potential to $1, which is the spread between the two contracts here. And then, of course, we do collect premium, and we're going to collect 0.3, 30 cents basically in premium. So we deduct that off the dollar of risk, and we end up with a max loss of 70. And our broker knows our max loss is now limited, it's no longer unlimited. So we're only going to require $70 in buying power to open this position. And now all of a sudden we've turned a very poor return on capital trade into a very high return on capital trade. And if you look at our probabilities of success, we've got a 60% probability of success, probability of profit, and a 77% chance of hitting 50% of max profit over the next 45 days. So our probability of profits do decrease slightly, roughly by about 10%, but our return on capital exponentially increases. And a $70 position, this should be able to fit in pretty much everyone's portfolio. So that is how you can find positions, and that's how you can manipulate positions. Even very big positions, you can manipulate them in the same way. Now, how do you know how much buying power you should allocate to your positions? Well, in order to figure that out, we've created a position sizing template, which is free for everyone to use and get a copy of. Link is in the description. The way it works is you enter in the size of your portfolio at the top, and then below you enter in what the current VIX level is, and then everything below will then be dynamically calculated to tell you exactly how much buying power you should allocate to any single undefined risk position, defined risk position, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow this, you will be just fine over the long term. If you want to learn in more detail, again, link is in the description. Click on EDS Premium and get yourself signed up. Once you're in, you will have access to our portfolios that you can see. The positions that we're placing in real time, adjustments that we're making, how we're managing risk. You can use it for inspiration, or you can just copy us. It's fine. There's also a full course inside, so no prior knowledge is required. We will teach you absolutely everything that you need to know from start to finish. Both of those two things, in conjunction with it being a private community that allows you to ask questions directly to myself and to other like-minded individuals who are all on the same path as you. All of these things combined will set you up for success. And within 6 months to a year, you'll know exactly what to do and how to do this for the rest of your life without any help from anyone. So if that wasn't enough and that didn't convince you to join, then there is also a 100% money back guarantee. So if after 6 months you studied our full course, followed our trades, etc., and haven't seen results for any reason, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part. And right now it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you. You don't need to worry about price increases. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.